Hi guys, welcome back to How What Why. Buying assets and settling liabilities is the ultimate formula for improving one's financial position. When a person settles their liabilities and increases their assets, their net worth and cash inflow begin to increase. But we often see people buying liabilities, thinking they are assets. Wait, do people actually buy liabilities? And does confusion exist between assets and liabilities? In this video, we are going to discuss these matters related to assets and liabilities. First, what is an asset? An asset is a resource owned or controlled by an individual, corporation, or government with the expectation that it will generate a positive economic benefit. In short, anything that put money into our pocket is an asset. Next, let's see what a liability is. A liability is something a person or company owes, usually a sum of money. Liabilities are settled over time through the transfer of economic benefits including money, goods or services. In other words, anything that takes money out of your pocket is a liability. We can sum up the idea with this diagram. Asset brings more income to the owner, but liability on the other hand increases the expenses and takes money away from the party. Now let us look some examples. Examples for assets include stocks, bonds, real estate, intellectual properties, etc. These items earns income for the owner. Then, liability includes mortgage, car loan, credit card loan, education loan, etc. These items increase the expenses and results in increased fund outflow. According to the famous book Rich Dad Poor Dad, rich people buy assets and thereby increase their income. But, middle class and poor people buys liabilities, thinking they are buying assets. How does that happen? Middle class people, as soon as they have some savings, decide to buy a car. Maybe by paying the full amount or through EMI. They think it will become an asset for them, but what really happens is that the car draws money from them in the form of insurance, tax, fuel, repairs and maintenance, depreciation, etc. Thus increasing the expenses and fund outflow. If this car were used as a rental or taxi, it could bring income and be called an asset. Until then, it is a liability for the owner as it only brings expenses and no income. Now let us think about house, as a major portion of our investment goes into the category of house. There is a highly controversial statement in Robert Kiyosaki's book Rich Dad Poor Dad that says, "Your house is a liability." If you haven't read this book, I recommend all viewers to read it. What do you think about his statement? Is your house a liability or an asset? Share your opinion in the comment section. Subscribe to this channel for more interesting topics like this, and share this video to all your friends who would find it useful. Stay tuned to How What Why.